Bismillahirrahmanirrahim. This is Amir Shabi, a student of application level. This is my first video lecture on accounting, and this video lecture is solely designed for the students who are studying CA in knowledge level. Before we start our lecture, I want to show you the total CA curriculum. In knowledge module, we get that 7 courses, and one is accounting, which is especially basic accounting. In application modules, you also get 7 courses, and there is another accounting course, that is financial accounting. And in advanced level, we will get financial and corporate reporting. Both application level and advanced level accounting are the advanced stages, accounting courses for the advanced stages. So for betterment, we have to understand the accounting in knowledge level modules is very clearly, so that in future we don't get any problem with accounting. Today we will discuss about chapter 1, that is introduction to accounting. The topic will be covered, that is the purpose of accounting information, the main financial statements, the regulation of accounting, the qualitative characteristics of accounting information, capital and revenue items. Here one thing, this course this lecture is totally designed from the accounting manual. So you'll get that all the information are same, but one thing is that I try to update some information which already is amended in BS1 or in other financial regulations or in other manuals. So this video lecture is totally updated, and if any information is you think that is backdated or any other problems with the information, just let me know. Okay. Then our learning objectives will be specify why an entity maintains financial records and prepare financial statements, and record and account for transactions in accordance with the laws, regulations and accounting standards applicable to the financial statements. These are the learning objectives of this chapter. Before you start any chapter of any manuals or any courses, you have to understand what is the learning objectives of the chapter and what is the topics you are covering. So that you can get a clear understanding of that chapter. Exam requirements. You may find some questions relevant to this chapter. Identify capital as opposed to revenue expenditure. Distinguish between the different qualitative characteristics. Identify the principles that relate to each qualitative characteristics. Identify the different interests of stakeholders. So keep in mind that this is not the only questions. This is some questions that may come in the exam, or that may the examiner want to check in the examination hall. So after covering this chapter, you have a clear understanding of this exam topic. Now let's start with what is accounting. The bookish definition that you get, that accounting is a way of recording, analyzing and summarizing transactions of an entity. And in another way, you can say accounting is a process of recording transactions in books of original entry, analyzing and classifying to the ledgers, finally summarizing in the financial statements. Look here, by the end of the line, each line I mentioned the chapter. That is, recording transactions will be discussed in chapter 3, analyzing and classifying it to the ledger will be discussed detail in chapter 4, and finally summarizing the financial statements will be discussed in chapter 5. Another definition is accounting is a systematic process of identifying, recording, classifying, summarizing and communicating financial information. Let's try to understand what actually these two definitions want to say. And please, dear viewers, please don't try to memorize this definition. Try to understand what is actually want to say. There is two things in two definition. That is, accounting is a way. That is, the word a way is used in first definition, and in the second definition, accounting is a systematic process. A systematic process is defined as a systematic process. In a way and a systematic process here are the same things, so don't get confused that a way is different things or a systematic process is another things. So accounting is a way of recording. Look, recording, first of all is recording. We have to record economic events, that is the transactions, and then analyzing means analyze the recorded transactions, and then classifying in the ledger, and summarizing means preparing the trial balance of financial statements and preparing reports, something like that. So total process, a systematic process, that's why it is called a systematic process. Total process is included in accounting. Not necessarily that Journal is the accounting, or the ledger is the accounting, or journal or ledger is the account, and ledger is the accounting. Accounting means starting from the identifying the transactions and recording it to the accounting books, and ends with the communicating the data to the users. So accounting is a big process. So if you understand this definition, let's try to solve the self-test one that is directly copied from our accounting manual. An entity's transactions are recorded first in option A, books of original entry, option B, ledger accounts, option C, the income statements, and option D, the balance sheet. So which is the correct answer? Let's go again to the definition. Here in this line, recording transactions in the books of original entry. So when an entity's transactions are recorded, that means recording a transactions in the books of original entry. So recorded first in the books of original entry. So the correct answer is books of original entry. I hope you understand this. Now let's go to our next topic. Types of business entity. There are three main types of profit-making business entity. First one is sole traders, that is the owner have a full ownership of the business. For example, local shopkeepers, hairdressers, that is nearly our doors. These are the sole trader business. And second one is partnership. Two or more people share the risk and rewards. That is, two or more people comes together and they want to do a business and to share the risk and rewards, everything, and they are doing their business together. For example, accountancy, medical or legal practices, that is the accounting firm, this chartered accountant firm, that is also these are the very good example of a partnership firm. And the third one is limited liability companies, that is the liability of the owner is limited, and the shareholders of a limited liability company are only responsible for the amount to be paid for the shares. Here is the point, the amount to be paid for the shares, that is their liability is limited by their shares or the specific amount guaranteed by the members to be contributed to the company and guaranteed by the members. So the liability is limited by the shares or limited by the guarantee. Two types of guarantee here, two types of liability is here, that is liability limited by shares and liability limited by guarantees. Okay, these three types of business is the profit-making business entity. And if you understand this, let's try to solve the self-test 2. That is, liability for the debts of the business does not fall on. Liability for the debts of the business does not fall on. Okay, option A, the sole trader. Option B, partners in a general partnership. Option C, a limited liability company. And option D, shareholders. Okay, let's try to understand what this question want to say. Liability for the debts, that is liability, the ultimate liability of the business does not fall on which? Let's explain. A sole trader, here is the ultimate liability of all his business. He have full ownership and full liability. So the debts of the business of a sole tradership business definitely fall on the sole trader. So this is not the answer. A partnership in a general partnership. Partners in a general partnership. Here also, the debts of a partnership business definitely fall on the partners because they share risk and rewards. They don't have limited liability. And third one is a limited liability company. The debt of a limited liability company does fall on that company, and that does not fall on the shareholders, because shareholders' liability is limited by their shares or by the guaranteed. So here our option is D. Correct answer is D. That is, debts of the business does not fall on shareholders. Let's go to the next point, that is the objective of financial statements. What are the objectives actually of the financial statements? Let's see. As per BS1 para 9, the objective of financial statements is to provide information about the financial position, financial performance, and cash flow of an entity. That is useful to a wide range of users in making economic decisions. Okay, here are three objectives, that is financial, that is to provide information about the financial position and financial performance and cash flow of an entity. So from a financial statements of a company, we'll get the information relating to financial position, that is the balance sheet of the company, the financial performance, that is the income statements or the change in equity, and financial the cash flow of an entity, the cash flow of that entity. And these three information is very useful to take economic decision or to make economic decisions. And what is the economic decisions? The question arises here. Let's see. What is the economic decision? Economic decisions may be investing in the stocks, lending money, or buy or sell products. Investing in stocks, that is someone wants to invest in any company. So before he making the decisions, he wants to know that the company, whether the company has a good financial position, or how the company is performed last couple of years, blah blah blah, etc. And lending money means if any bank wants to lend money to a company, definitely he wants to know the financial position before lending the money. And buy or sell products means that if a customer or the supplier wants to buy or sell products to a company, they must want to answer the understanding, wants to know the cash flow capability, cash paying capability of the company. So every information here is related, and that is directly derived from the financial statements. Okay, I hope you understand the objective of financial statements. In BS1 para 9, it is also stated that financial statements also show the result of management stewardship of the resources entrusted to it. So there is two objectives we get here. First one is the objective is to provide information of relevant information, and second one is show the results of management stewardship of the resources entrusted to it. First one is who is entrusting the resources, and second one is what is the management stewardship. Management stewardship is a very simple thing, that is management, the board of directors or the top management is responsible for keeping the resources safe and sound, and making business with those resources, and paying to the shareholders, who actually the entrusted party here. So the shareholders or the owners of the business entrusted resources to the management, and management shows the result by a financial statements that the stewardship is okay or whether okay or not. Okay. If you understand the objectives of financial statement, let's try to solve the self-test 3. That is, according to the BFRS framework and BS1, which of the following does not represent an objective of financial statements? According to BFRS framework and BS1, which of the following does not represent an objective of financial statements? Okay. Option A, to provide information to investors in making economic decisions, to provide information to managers in making business decisions, to show the results of management stewardship of the resources entrusted to it, to help users predict the entity's future cash flow. Look, here three things already you can easily eliminate. First one is to provide information to investors in making decisions. It is clearly a sign of an objective of financial statements, so you can eliminate this option, because in this question they want to know that following does not represent an objective. So which one is not the objective of financial statements? To provide information to managers in making business decisions. First of all, management is here the responsible for preparing the financial statements. So it's maybe that the manager make decisions from their financial statements, but it's not the objective of a financial statement to provide information to the managers, because manager is responsible for preparing the financial statements. Let's see. So this is our answer, but before answering the questions, so let's consider the next two options. To show the results of management stewardship of the resources and this is the second objective. So from our discussion you will understand. To help users predict the economic entity's future cash flow, this is also the objective. So our answer is here B, to provide information to managers in making business decisions. This is not the objective of financial statements. Okay, next topic is who needs financial information? That is the user of financial information. First of all, managers or directors. To manage the business efficiently and to make effective decisions. That's why managers or directors need financial information. Shareholders. Why shareholders need financial information? To assess management's performance. The shareholder assess the management's performance from financial information, so they need those information. And suppliers, they wants to know the company's ability to pay its debts, so they need the financial information. Customers, a secure source of supply. Customer definitely wants a secure source of supply, so whether the company have the ability to secure the supply, the customer wants to know, and they can understand, they can get this information from financial information. Finance providers of bank, to operate an overdraft are able to keep up loan payments. Those party who actually lend money to a company, they also know that they have they can operate an overdraft, or they have the ability, the company have the ability to keep up the loan payment, so they also need the financial information. And the next one is National Board of Revenue. Okay, that's the most crucial thing, that they are the actually revenue maker of a country, so they wants to assess the company's tax liabilities, so they need the financial information. Employees, are the main workers basically of a company, and they want to secure their career, and they want to secure their remuneration, so they for the purposes, so they want to know the performance of the company, and that's why they need the financial information. Financial analysts and advisors, to advise investors, to advise potential suppliers of goods to the company. Yeah, there is thing that advisor needs information for to make to advise the investors. Definitely, to advise investors to make a decision, economic decision, and that is already well discussed. And to advise potential suppliers of goods to the company, and that is also a reason. That's why they need a financial information. Government agencies, efficient allocation of resources. Government wants to know that the company, whether the company efficiently allocates the resources. The public, general public, definitely the effect of an entity of the natural environment. Normally the general public does not interested in the revenue or the financial position of a company. They actually interested in the nature, whether they are harming the natural environment or other causing any problems with our environment, so they need the financial information. And the question is whether the financial information can give such thing that the company can cause a problem in natural environment or make any harms to them. Yeah, financial can show such kind of information that we will discuss in our future lecture. These are the parties that needs actually financial information. Now, if you understand these, let's try to solve self-test 4. Which two of the following issues in an entity's financial statements are identified by the framework as being of interest to the public? Which two of the following issues? You have to find two issues in an entity's financial statements. That is, in an entity financial, there are two issues identified by the framework. Framework identified as being of interest to the public, which have interest in the public. Okay, first of all, first option is whether the entity has paid a dividend. Dividend is not an issue that public wants to know. Dividend is definitely related to the shareholders. Whether the entity will repay a loan when it falls due. This is a issue that the lender wants to know. Option C, whether the entity will contribute to employ people. Okay, there is people, that is there is a normal people who actually are the public that who have interest. This is an option, I think. And whether the entity will continue, whether the entity patronizes local suppliers. Local suppliers, they're also general public. They want to secure their business. So these are correct answers are C and E. That is, whether the entity will continue to be able to employ people, or whether the entity patronize local suppliers. Now let's go to our next topic, the main financial statements. We all know the content, or all know the main financial statements. But here is a thing that based on presentation of financial statements identifies a complete set of financial statements as comprising a statement of financial position, that is balance sheet, a statement of profit and loss and other comprehensive income, that is income statements, a statement of change in equity, a statement of cash flows, notes comprising significant accounting policies and other explanatory information and comparative information, and finally a retrospective restatement if necessary. So there is a totally seven components of financial statements. Now we all very familiar with these 5 components: a statement of financial position, a statement of profit and loss, a statement of change in equity, a statement of cash flows, and notes. But there is also the other two components, that is comparative information, a retrospective restatement. These are directly taken from the para 10 of BS1. If you want to check, you can go. These two are added in the last amendment. So we have to we can answer. And if a question comes in our exam that what is the main financial statement, you can write this 5. But if you know if you have understand para BS1, you can write all the 7 components. Now, what is the main financial statements? We already get it, and now we will try to solve the self-test 5. A balance sheet is described as that is what is the balance sheet. It is a function of balance sheet, a snapshot of the entity's financial position at a particular point in time, a record of an entity's financial performance over a period of time, that is option B. Option C, a list of all the income and expenses of the entity at a particular point in time, and a list of all assets and liabilities of the entity over a period of time. So by the elimination method, we can easily eliminate here option B and C, because option B says record of an entity's financial performance. Okay, balance sheet does not show financial performance. And in option C, a list of all income and expenses of an entity. So this also can be eliminated easily. Here our rest of the option is option A and option D. Now try to explain. A snapshot of the entity's financial position at a particular point in time. Here, point in time and a period of time. Two phrase of underlined. This point in time means at a particular point of time. That is the balance sheet. We all know that balance sheet is prepared only for a particular point of time. That is, I am preparing balance sheet as 31st December or 30 June. The financial position will be shown only for that date, not for the entire period. So a period of time is relevant to the financial performance, that is income statement or change in equity or cash flows, but balance sheet is solely prepared for point in time. So our answer is a snapshot of the entity's financial position at a particular point in time. Here is the explanation. The balance sheet is a list of assets and liabilities which represent the entity's financial position at a particular point in time. D is wrong because it refers to a period of time. C refers to the income expenditure, not assets and liabilities, and B defines the income statement. So here only option is rest is A. The regulation of accounting. This is our next topic. A number of factors have shaped the development of accounting. So what are the factors? First one is legislation, the local legislation definitely. That is the Companies Act 1994, the Banking Companies Act 1991, and other acts also. I only put these 2 things here. Accounting concepts and individual judgments. And there are some issues that need actually some judgment or concepts. These may be valuation of assets, making provision. We all know that valuing an asset, and time of valuation of an asset, we need to do it in our judgment, to use our judgment, and in making provision we also need judgment. Accounting standards, that is BAS and BFRS. BAS stands for Bangladesh Accounting Standards and BFRS stands for Bangladesh Financial Reporting Standards. Commonly used accounting practices, that is UK GAAP, US GAAP. GAAP actually generally accepted accounting principles, that is a country's local legislation, laws or other practices. So UK GAAP means the practice in the common practice of accounting in United Kingdom, and US GAAP is common practice of accounting in United States. We can also say for our country we follow the local GAAP. There may be some practices for our local, that is we practice in locally, that is not necessarily to be practiced in widely in other countries or other areas. Next one is true and fair view and fair presentation. These 5 are the regulations of accounting. This is actually sort of different from last these four regulations, that is true and fair view and fair presentation. This is actually fair presentation or true and fair view, actually what financial statements or an accounting must have to show that is carrying a true and fair view or fair presentation. We'll discuss in future lectures. Now try to answer the self-test 6. In applying fundamental accounting concepts, the preparers of financial information are also using. In applying fundamental accounting concepts, the preparers of financial information are also using legislation, accounting standards, judgments, financial reporting standards. So fundamental accounting concepts, which one is actually related to fundamental accounting concepts, that is concepts directly related to the judgment. We already discussed in the previous slide, that is concepts and regulations. Concepts and judgment are one of the regulation of accounting. So here the answer is judgment. Explanation: here is many figures in financial statements are derived from the application of judgment in putting fundamental accounting concepts into practice. That is, we have to use have to apply our judgment in some financial figures. Okay, now our next topic is qualitative characteristics of financial information. As per chapter 2 of Conceptual Framework for Financial Reporting, qualitative characteristics of useful financial information are as follows. There is a chart, that is qualitative characteristics can be divided into types: fundamental qualitative characteristics and enhanced qualitative characteristics. What are the fundamental characteristics? That is relevance and faithful representation. And what are the enhanced characteristics? That is comparability, verifiability, timeliness and understandability. Okay, let's discuss about this. Fundamental qualitative characteristics. First one is relevance. It helps users evaluate past and present events and predict future events. Look, here relevance means evaluating past and present events, that is what happened in the past and what is actually happening in the present and what will be happened in the future. So there is a prediction that we have to make by evaluating the present and past events, and for making these decisions, relevance characteristics is very helpful. Information's relevance is affected by its nature and maturity. Of course, nature and maturity does affect the relevance. Next one is faithful representation. To be faithful, get the understanding from these two words: faithful representation. That is, the representation of financial statements must be faithful. Very simple thing. So, to be a perfectly faithful representation, a depiction would have 3 characteristics. Complete. Definitely, for a faithful representation, the information must be complete. and neutral. Of course, information must be neutral without bias in the selection and presentation of financial information. If it is not neutral, we can't get the faithful representation. And free from error, definitely. No errors or omissions in the description of the phenomenon and the process used to produce the reported information, but it doesn't mean perfectly accurate in all respects. That is, faithful representation must be free from error, but not necessarily mean that it is 100% perfect and accurate information that we get. There may be a little error or something, but it must be very lower level. That is, the decision of an investor or the economic decisions cannot be influenced, cannot be mistaken by this error. So these are the fundamental qualitative characteristics, and next is enhancing qualitative characteristics. These are comparability. What is the comparability? Very simple thing, that is we have to compare the data, financial information from current year with previous year, or the between the same industries, or something else like that. There is to identify and understand similarities in and differences among items. For example, comparing information of two similar entities. That is, for example, I can say an example, that is for example, Crown Cement. Okay, we can compare the information of a Crown Cement with Shah Cement or Lafarge Shurma Cement. That is the similar entities. Or we can information of one period with another periods. That is, if we want to compare the information of 2015 with 2014, that is information of one period with another period, comparison of one period with another period of similar entities. Next characteristic is verifiability. That is, the information that we get from financial information must be verifiable. Verifying an amount or other representations through direct observation, for example by counting cash. That is, for example, in a balance sheet, cash position shows that a company has taka 1 lakh in their hand. So we can verify by this taka 1 lakh by physical cash counting. That is the verifiability actually. And you can also verify inventory and other fixed assets, or other liabilities, or assets, receivables, that you can easily verify by sort of cash counting, inventory counting, fixed asset verification, or by circularizing receivables, payables. And these all are the examples of verifiability. And third one is timeliness. Having information available to decision makers in time to be capable of influencing their decisions. Here, timeliness means you need the information, proper information, on time. Okay, so for example, if you want to buy some shares of XYZ company, so you need the information before those company making dividend declaration, or making huge steps. So if you get the information before the declaration of dividends, or before the making decisions, you'll buy that, you'll easily take the decisions. If you get the information after the declaration of dividends, or after making the steps, you cannot make your decision. So timeliness is very important. So if you want to make economic decisions rightly, you need information in time. And the last one is understandability. Understandability is a very simple thing. That is, you have to understand what actually information wants to say. That is classifying, characterizing, and presenting information clearly and concisely. That is, for example, in financial statements, there are many kind of expenses. For example, rent expense, salary expense, audit fees, operating expenses, many other things. If a non-operating expense is classified as an operating expense, or if a advance payment is classified as an expense, that will be, and that will not be concisely presented, and it will make the information very and tough to understand what actually the information contains. So understandability is very important for financial information, and for a clear for a good financial information, we have a clear understanding of the information that is given. Our next topic is capital and revenue items. Expenditure, first of all, is expenditure. Expenditure can be classified in two ways: capital expenditure and revenue expenditure. And now, what is capital expenditure? Capital expenditure which results in the acquisition of long-term assets or an improvement or enhancement of the earning capacity. That is long-term assets. What is the actual long-term assets? That is kept in the entity for more than 1 year. Some assets which we purchase and kept in more than 1 year, and it is used in the earning capacity, that is we earn from our assets by using our assets. So for any expenditure that is solely for purchasing, acquisition of long-term assets, or improving that assets, or making an enhancement for the long-term assets, that is could be called as an capital expenditure. And now revenue expenditure which is incurred either for trade purpose, either for trade purpose or to maintain the existing earning capacity. And what are the expenses for trade purpose? That is purchase of raw materials, wages and salaries, selling and distribution expense, administrative expense, and finance costs. These all are expenses for trade purpose. This is actually revenue expenditure. And to maintain the existing earning capacity of the long-term assets, that is maintaining the long-term assets, also revenue expenditure, that is repair and maintenance expenditure. These are two classifications of expenditure, that is capital expenditure and revenue expenditure. I hope you understand this. And now, capital and revenue items. Income can be classified in two ways, that is capital income and revenue income. Capital income, what is capital income? Proceeds from the sale of non-current assets. If we purchase a non-current assets, that is capital expenditure, and if we sell a non-current assets and we get something, get an income from that, that will be capital income. Very simple. And the revenue income derived from the sale of trading assets such as goods held in inventory, the provision of services, the interest and dividends received from the business investment. What actually income is, when we are trading something, inventory, that is our sole business of sole purpose of business, trading is something. Income derived from that is revenue income. The provision of service, when providing a service, and income derived from a service is revenue income. And the interest and dividends received from business investment, that is also the income, that is also revenue income. Okay, now if you have an understanding of capital and revenue expenditure and income, let's try to solve the entire question number 3, that is capital or revenue. State whether each of the following items should be classified as capital or revenue expenditure or income. First one is the purchase of property, for example, an office building, property depreciation, then solicitor's fee in connection with the purchase of property, the cost of adding extra memory to a computer, the computer repairs and maintenance cost, the profit of on the sale of an office building, revenue from sale by credit cards, the cost of new machinery, customs duty charged on machinery when imported into the country, the carriage cost of transporting new machineries from the supplier's factory to the premises of the business, purchasing it, the cost of installing the new machinery in the premises of the business, the wages of the machine operators. Let's try to solve this. First one is the purchase of property. So purchase of property is definitely a one-time expenditure, just like that. So it's a capital expenditure, and the capital expenditure, from the definition you get that an expenditure is an expenditure that is for acquisition of a long-term assets. So property is a long-term asset, that's why it's a capital expenditure. Next one is property depreciation. Property depreciation is a depreciation by warranty or by use is a revenue expenditure, because every year the value of property is depreciated, or the value of property is decreased. So the value is charged in the income statement as expenditure, as depreciation expense. So this is revenue expenditure. Next one is solicitor's fee in connection with the purchase of property. Okay, Solicitor's fee is only is happened when with the purchase of property. So when purchasing a property, we need the solicitor's fee, and this is connected to the purchase of property. So it is also an expenditure for acquisition of a long-term asset. So it is a capital expenditure. The cost of adding extra memory to a computer. Extra memory, okay. Extra memory is an enhancement of a long-term asset, that is a computer. So this is a capital expenditure. Computer repairs and maintenance cost. Repair and maintenance of a long-term assets, long-term asset, that is computer, is a revenue expenditure. And profit of on the sale of an office building. When is selling a long-term asset, that is office building, and the profit made from the sale is a capital income. So this is a capital income. Revenue from sales by credit card. Credit by selling credit card is a trading activity. So this is revenue from a trading activity, is revenue income. The cost of new machinery. That is the cost of new machinery. This is directly same as option A, that is purchase of property. So this is a capital expenditure. Custom duty charged on machinery when imported into the country, capital expenditure. This is also linked with the purchase of machinery, and this is solely for that purchase. So this is a capital expenditure. The carriage cost of transporting the new machinery from the supplier's factory to the premises of the business purchasing it. This is a capital expenditure because this carriage cost happened for the new machinery purchased, and this is only for the purchase. So this is a capital expenditure. The cost of installing the new machinery in the premises of the business, that is also capital expenditure, because this is the installation cost that will happen only one time for the installment. So for installing the machinery. So this is a capital expenditure. The wages of the machine operators. Machine operator, every day operates the machine for making products. So this is a trading activities. So this is a revenue expenditure. Okay, that's all for today. If you have any queries in your mind, if you have any questions, or if you get any information that is not clear to you, or you get puzzled with some information, let me know. I'm Amir Shabi, always available in the email address given in below of every slide, and there is a contact number that is you can call directly to me or send an SMS. If you can't reach me, just send an SMS. I'll call you back, or I'll reach you. And you all know that this lecture is I tried to prepare the all data to be updated. If there is any problem, if there is any lackings, just let me know. I'll try to make it better in future. So thank you all. Allah Hafiz.